Hi, I'm Dong Sean. Welcome to Dig Into China, where we explore China in depth to review unique perspectives. Last week, China's stock market finally exposed the so-called East Rising, West Failing narrative as a complete sham. On Thursday, Trump announced that starting March 4th, the US will impose a 25% tariff on Canada and Mexico, along with an additional 10% tariff on China. This immediately dragged down the US stock market that day. But Canada and Mexico had already sent representatives to negotiate with Trump's administration. Just like before, their tariffs will likely be raised high and then quietly lowered. In fact, media reports suggest they may even offset these tariffs by increasing tariffs on China instead. However, that extra 10% tariff on China, that's definitely happening. Starting in March, the average tariff on Chinese goods in the US is close to 40%. Once again, Trump's tariff hammer is coming down hard on China. And on Friday, it crushed Hong Kong and A shares. Xi Jinping has spent so much effort and money pushing up Hong Kong stocks, only for Trump to smack it back down with a single tariff announcement. On Friday, Beijing continued trying to prop up the market with a net inflow of 11.9 billion Hong Kong dollars. Yet, the Hang Seng Index still fell 3.28% and the Hang Seng Tech Index dropped 5.32%. I don't know if any of you invest in Hong Kong stocks managed to avoid this downturn, or if you decided to buy the dip and bet on China's future. But let me remind you, right now, do not use leverage and do not play with options. Stick to regular stocks or you'll risk getting wiped out. Now let's talk about tariffs. The US keeps slapping new tariffs on China, one round of 10% and then another 10%, practically once a month. And they've even rallying allies to do the same. But what about China? It looks like Xi Jinping isn't reacting much this time. Last time we analyzed China's so-called countermeasures, which were nothing more than a performance for the domestic audience. It's honestly surprising to see China taking such a soft stance. So is there more grand strategy behind this silence? In this video, I'll take a bold guess at what's really going on in Xi's mind. First, let's talk about why China's tech stocks have been surging this year and why Beijing keeps pouring money into Hong Kong's market. The answer lies in a recent article by China's securities regulator chief Wu Qing. The article is titled, "Fully Utilize the Capital Market to Better Serve New Industrialization." This so-called new industrialization is China's current push for technological progress. Wu Qing openly stated that China's massive market, strong industrial base, and a state-driven innovation system provide a solid support and vast opportunities for this goal. The key takeaway, it's all about state-driven tech investment. Wu Qing even called on all Chinese investors, both institutions and retail traders, to participate in this national feast, to bet on tech, pour their savings into investments and share the risks and the rewards. In other words, even Xi Jinping is going all in, so what are you waiting for? This is your one shot to bet on China's future. Blunt enough, huh? If they could, they would probably take every single Chinese citizen's savings and pump it into the stock market. So Wu Qing make it crystal clear, this so-called tech innovation boom is entirely driven by the state. And as long as the tech stocks rise, they can claim that China's tech sector is advancing and that the state-driven model has triumphed over the US market system. But let's be honest, these people never miss a chance to hype up Xi Jinping because he truly believes in this state-driven model. He sees companies like DeepSeek AI as a proof of its success. That's why he's convinced that China's tech sector is worth investing in, and that's why he's throwing money into the market, hoping to attract foreign capital. For him, foreign investors recognizing China's stock market means the state-driven model has defeated the US market system. So he keeps pumping money into Hong Kong stocks, waiting for foreign investors to follow. And if they don't come, he just keeps holding the market up. one stubborn push after another for over a month now. There are plenty of signs showing that Xi Jinping has once again trapped himself in an industrial revitalization echo chamber, feeling inspired and unable to snap out of it. The first clue, China's finance ministry and the central bank have basically stopped doing anything. According to major financial institutions that have participated in government meetings, the authorities believe that China's economic indicators are looking great. They see no need for stimulus. For example, in January, China's CPI rose 0.7% month-over-month and a half percentage year-over-year. So where is the deflation? PMI dipped slightly below the growth threshold in January due to the Lunar New Year, but it's expected to bounce back in February. That means manufacturing is booming, and the real estate? Sure, China's new home sales were still declining in January, but home prices actually went up. According to the China Index Academy, new home prices rose 2.76% year-over-year. Several major cities even saw record-breaking land auctions. So the economy is off to a stable start this year. And then let's not forget the stock market. The tech boom has supposedly revived investor confidence. As long as the stocks are up, everything else will be fine. So why bother with the stimulus? Now, with 2 sessions, China's annual legislative meetings coming up, the market is hoping for new stimulus policies. But judging by the current signals, don't get your hopes up. In fact, it might be a good time to bet against the market, because Xi Jinping thinks China's economy is doing just fine, and if that's the case, there's no way he'll approve large-scale stimulus. The central bank has made a sharp U-turn compared to the passive stance of the fiscal department. Back in January, the central bank had undergone the largest expansion in history, flooding the market with liquidity and boosting financial data. But by February, it abruptly reversed the course and started tightening liquidity again. According to major domestic financial institutions, the central bank is deliberately creating a cash shortage to push up government bond yields. In January, the excess liquidity ended up flowing into the government bond market instead of being used for loans, causing bond yields to deviate from the central bank's target. Now the central bank is adjusting its approach. Liquidity will only be provided based on fiscal needs, and the current tight conditions will likely last until after the 2 sessions. If there is a major issuance of government bonds in the second quarter, then the central bank will respond by easing liquidity. Once you understand this shift in strategy, it becomes clear why the yuan has remained strong recently. If the central bank isn't focused on injecting liquidity, then its priority naturally shifts back to stabilize the exchange rate. Right now, with a strong stock market and a tech sector holding up well, the central bank is seizing the opportunity to strengthen the yuan. Otherwise, if a tech bubble bursts later and the economy needs a rescue, the central bank would have fewer options left, and the exchange rate could collapse. So, in addition to tightening yuan liquidity, the central bank has also ordered major banks to lower interest rates on US dollar deposits. Some Chinese netizens have reported getting annual interest rates as high as 5% for US dollar deposits at the Beijing bank. With dollar deposit rates far exceeding those of yuan deposits, many people have been exchanging yuan for dollars over the past 2 years, putting pressure on the exchange rate. Now, by forcing banks to lower dollar deposit rates, the central bank is shrinking this arbitrage opportunity, making it less attractive to hold dollars. This helps support the yuan's value. However, this recent strengthening of the yuan is only a short-term phenomenon. As I just explained, the central bank is making these moves to give itself more bargaining power for future economic downturns. When will it start injecting liquidity again? That depends on when the stock market crashes, when the US raises tariffs again, or when fiscal authorities begin large-scale borrowing. These are the key macroeconomic signals to watch for those trading foreign exchange. At the core of all this, the position of both the fiscal and the central bank officials reflect the stance of Xi Jinping himself. He believes China's whole-of-nation system has successfully propped up the tech sector, and the national rejuvenation through technology is within reach. Since the macroeconomic situation appears stable, he sees no reason for both fiscal and monetary authorities to loosen policies and drain national resources just to boost short-term growth. Xi's vision sounds ambitious, but failing to anticipate and prepare for macroeconomic shifts is already a mistake. On top of that, he is making a second mistake, misjudging the US tariff threat. During the last US-China trade war, Xi took a hardline approach, confronting the US head-on. But this time, he has chosen to endure in silence. In his own words, he wants to calmly deal with external risks, a clear reference to US tariffs. Yet, from what we know, Xi has made no effort to negotiate with Trump, while other countries targeted by Trump's tariffs are scrambling to talk to Washington. Xi hasn't even made a phone call. Instead, China's foreign ministry has issued a few tough-sounding statements, while Xi himself acts as if nothing has happened. It's almost as if he's practicing some kind of martial arts technique that requires absolute patience, like a character from a Chinese martial arts novel, standing still while the storm rages around him, convinced that ultimate victory will come in time. But in reality, he seems to be gambling everything on one bet. He believes that if China's tech sector truly rises, US tariffs will no longer pose a threat. His mindset is like a warrior locked in a secret chamber, practicing an unbeatable technique, convinced that once he masters it, he can crush all enemies in an instant. Now it's up to everyone to decide where to place their bets. If you believe Xi's plan will succeed, then the current market shock from US tariffs is just a short-term setback that can be endured. But if you think he is deceiving himself, then as the US imposes more tariffs, China's stock market will crash. If tariffs reach 60%, the economy will take a severe hit. And by the time Xi finally decides to negotiate, China will be in a much weaker position. Logically, now should be the best time for talks. China's tech stocks have surged, economic data still looks decent, and the yuan remains strong. Meanwhile, the US is preoccupied with its own domestic issues. Right now, China has the bargaining chips, investment in the US, the fentanyl issue, but Xi remains trapped in its own information bubble. He truly believes that China's whole-of-nation approach can drive technological innovation and surpass the US through shortcuts. But the real danger is this. What if he's following the wrong playbook? Imagine a martial artist finding an ancient manual that promises ultimate power. The first line reads, "To unlock ultimate power, you must first destroy your foundation." Convinced this is the key to success, he follows the instructions without hesitation. But when he reaches the final page, he realizes the devastating truth. Even after the sacrifice, success is not guaranteed. By then, the damage is done, and all he can do is cough up blood in regret. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, be well.